Hello everybody and welcome to the Like a Tortoise channel. I'm recording this video on Saturday 14th February and I will be posting this video today. Just to let you guys know, next week instead of having the normal 6 videos a week, I'll probably do I'll probably stick with 4 videos because I have some friends coming over here at our house here in London, and so I expect the certainly Monday and Wednesday to be a bit slow. But anyway, let's talk about what really matters. And today I want to talk about Pershing Square 2026 Annual Investor Presentation PDF that was released on February the 11th, so just a few days ago. It's actually the first time that I'm covering one of these reports here for our channel. And so bear with me as I do my very best to unpack everything you need to know. Of course, I mean, I think Bill Ackman, if you are following the channel, you probably know Bill Ackman very well, right? So he's the portfolio manager at Pershing Square. And he's a very outspoken figure and surely very successful and widely regarded as one of the best investors, certainly over the last few years. And so we will talk about some of his portfolio allocations, what he has done as of recently, and what we can learn from his investment decisions, right? Because that's the goal. Right, the report is quite extensive, as you can see. So we have about 28 pages, but I'll just cut to the chase. I want to focus on what's really on what matters. And so you can see 2025 performance review. What matters is, so you can see performance review 2025 return, Pershing Square net asset value net of fees, and total return versus indices total return. You can see that net asset value has grown by about 20.9%. In Pershing Square, share price has appreciated by about 30.9% versus 17.9% for the S&P 500 and 35.1% for the FTSE 100. And sure enough, what you can see, guys, is that in 2025, internationals have outperformed, and I do expect this to continue to be the case in 2026 as the overcrowded, overpriced American indices, American indexes become under pressure, right, because of valuations, and as people starting pulling money out of these overcrowded trades, then I expect rotation back into international stocks, similar to what we saw back in 2000s, right? Well, in 2000s at the peak of the bubble, right? That's what we saw. And also in 2008, which saw massive international outperformance. I do expect that to continue to happen, okay? But this is what really strikes me as incredible. Look at that, the cumulative net returns of the fund since inception. And you can see that in this chart, the way he breaks this down. And one thing I like about Bill Ackman is that he's very outspoken and he has no problem admitting his mistakes. And I want us to focus on that, right? Because Bill Ackman is a guy that right now runs a concentrated portfolio of high conviction companies. And typically he holds them for the long term, even though some of his recent decisions have been questionable, in my opinion. We will talk about that as well. But he follows an approach that is similar to the one we implement at Like a Tortoise, even though we don't like to pay as much as he does for quality. But anyway, we will also talk more about that as we go along the video. But the key thing is that he admits his mistakes, and this fund hasn't always acted that way, right? And so what I did is, this is something that is explained right here, right? Is that he basically divides the fund's performance that has occurred from 2004 all the way through 2026. He divides that performance. So you can see that the first 11.5 years since firm inception, that is January 2004 to 2015, and then there was a challenging period from 2015 to 2017, and then from 2018 all the way to where we are right now, This is what the calls the return to our roots, right? Created a strong path forwards that reminds us, let me just zoom in on this, that reminds us of our early roots, restructured to a smaller investment-centric organization, reinforced our core investment principles, exited problematic investments, stabilized our capital base. So let me break that down. And as always, I will be sharing this with our community in the WhatsApp group. So if you guys want access to that, just let me know and I will add you gladly. But what is the graph showing us, right? At the high level, you can see, so the blue line, Pershing Square cumulative net returns, green line, S&P total return, time frame from 2004 all the way to 2026. These returns are cumulative, not annualized. That's important to know. And that's why you can see that the Pershing Square net return of 2,500% versus 854% for the S&P 500. But let's move on. Okay, so today Pershing Square looks phenomenal, right? But the path to get there matters in quite a bit. Why they split performance into pre-2018 and post-2018. Remember, there is this dotted line right here on the graph, pre-2018 and then post-2018. And you can see that from 2004 to 2018, the performance is not as good as it is from 2018 to where we are today. This is when the performance really exploded. So what the heck happened during that time, right? All right, so phase one, 2004 to 2015, early years, labeled on the slide as years since firm inception. Performance was good, however volatile. At times, like the S&P 500, the firm ran too many positions, took bigger activist bets, right? Because they are known as a famous activist investor. For those of you who are new to the term, an activist investor is someone who takes positions in companies that are distressed, right? For example, we saw the case of Lululemon recently when a prominent activist investor took a $1 billion stake in the company, right? And what they do is they want to make changes. They believe the company's they still believe the company has a competitive advantage. Otherwise, they wouldn't have built that stake in the company. And then what they want is they want to restructure the business themselves. And what they do in many situations, right, is to replace the management team, namely the CEO. And so this is what an activist investor does. And let me continue here. And this is what happened. And made them. And then at the time they made some high-profile mistakes, namely Herbalife drug, right? Herbalife Valiant, and you can see Herbalife is definitely something that made a lot of headlines back then. And it destroys the returns over that time frame. Okay, so by 2015, cumulative returns were about 750. But then what happened is from 2015 to 2017, this was a challenging period. This is the uncomfortable bit, and they don't hide it. If I show you right here on the graph, look at that. Challenging period from August 2015 to 2017. This is where the performance significantly lagged the S&P 500. Sharp drawdown, significant underperformance versus S&P. Investors lost confidence, and this is when Ackman openly admitted mistakes. Key takeaway, the strategy was not working as intended. The 2018 reset, the real inflection point, the dotted vertical line that I already alluded to, from 2018 onwards, right? What actually changed? Smaller, more focused portfolio, investment-centric organization, instead of being asset gathering. Core principles formalized, exited problematic investments, stabilized capital base. This is Pershing Square saying, we changed how we invest, not tweaked, rebuilt instead. So phase 3 is 2018 present, permanent capital era. This is the key part. From 2018 onwards, performance massively accelerates. Volatility dropped, consistent outperformance versus the S&P 500, and you can see that returns explode over that time from about, as you can see right here, 400% all the way up to about the current 2,500%, right? And this is what we can see right here. This coincides with, again, more business quality focused. Fewer positions, less ego-driven activism, more compounders, namely Chipotle, restaurant brands, and Google as well, which has been, all of these companies have been fabulous investments for Pershing Square. Structural advantage from permanent capital. This is the Pershing Square most people think of today. And so what Pershing Square is implicitly telling investors with this chart is they make three subtle arguments. Judges mainly on the post-2018 era. We learned from failure and we don't shy from it. This is a durable setup. The phrase permanent capital era is doing a lot of work. No redemption pressure, ability to hold through volatility, better long-term compounding. And by the way, when they build a stake in Chipotle, if I'm not mistaken, the rock star CEO that they themselves put at the helm of the company, and his name is Brian Nicoli, who currently sits at the helm of the CEO position at Starbucks, right? I think they were the ones. I think it was Pershing Square who placed the CEO in the seat in the CEO seat at Chipotle Mexican Grill back then in 2025. After the company, excuse me, in 2015, when the company was going through a 50% drawdown, and the rest is history. The company has been a phenomenal compounder, and I think it's unfortunate that Starbucks didn't get to a cheaper level before Brian Nicoli took the helm of the CEO, because I wanted to invest in the company. It was in my radar for a while. It continues to be on my watch list, but it never got cheap enough. And now, and I'm pretty sure now with Brian Nicoli that the company is going to do fabulous things, because he's just an amazing CEO. Um, Okay, awesome. Right, so the honest investor takeaway: pre-2018 return shows skill in flaws. Big drawdowns are possible. Post-2018 return suggests a much stronger process, but still driven by concentration and judgment. This is not a smooth index like ride. It's high conviction, high accountability, high upside with scars to prove it. I love that. All right. Let's continue. This fits very well with what we do here at Like a Tortoise. For those of you who don't know, process matters far more than IQ. Fewer better decisions compound faster. We believe in running a concentrated portfolio of high conviction names. The biggest gains often come after painful learning phases. Great investors evolve. They don't stay rigid. And we at Like a Tortoise are always willing to learn, but we believe in the core principles that we follow, because these core principles are rooted in sound investment, in a sound investment framework that has been tried and tested. Very important to understand. Cool. So let's continue. What kind of principles are we talking about here that Pershing Square follows at heart? These principles, right? And you will find that many of them we apply at Like a Tortoise as well. Pershing Square core investment principles. Look at that. Key business characteristics: simple, predictable, free cash flow generative businesses. Does that sound similar to what we do here? Yes, it does indeed. Formidable barriers to entry, limited exposure to extrinsic factors that we cannot control, generally strong financial profile, minimal capital markets dependency, typically North American listed, large capitalization companies. I like that. I don't necessarily invest. My investments, as you guys know, are not really North American listed. In fact, many of them are not um, in that position. I mean, look, when he says North American listed, he's not really referring to American companies, is it? No, he's saying that they are listed in no, in the exchanges, so in the U.S. exchanges. And if that is the case, then all of our companies are in that position. So apologies. Uh, but we also like to invest in well-established companies. And if you are investing in a well-established company, then of course it's typically a large capitalization business. Attractive valuation, fair price, yeah, fair price, what he calls fair price, and I agree. He likes to pay a fair price. I don't like to pay fair price. I like to pay a low price, as is, but a substantial discount to optimized value. Base case valuation not reliant on future M&As or platform value. Exceptional management in governance. Occasional mispriced probabilistic investments must offer highly asymmetric return to compensate for possibility of permanent loss of capital. I don't like that. Yeah, I don't. When I go to into an investment, I never risk comes from not from volatility, but from permanent loss of capital. As Howard Marks many often has mentioned, I don't invest my money thinking there is a possibility of losing it. Okay? And so what he says here is that occasional mispriced probabilistic investments, this is something that I wouldn't do, because what is implied here is that he has no problem in investing, for example, in questionable companies, provided the upside is substantial, right? And so I just stay away from that. I like to stick with companies that are well established, great management teams, but then these companies, as we've seen time and time again, do go through periods of uncertainty. That's when we attack, right? So there are many great things here, right? And I like to incorporate some of these principles into my own strategy, as you guys know. So this is the permanent capital era of annualized returns. All right. And then let's move down. Look at that. And this is so interesting for us to analyze as well. And I think you guys will find this very educational. But remember, the reason we broke down his performance over time is because that will set the tone for the rest of the video. Look at his performance from 2024 all the way to 2026 by year, and look at the period. Look at that. Since inception, right? From 2012 all the way through 2026, despite the phenomenal performance that he achieved since 2018, right? His performance only net of fees stands at about 12.9%. And you can see that it significantly lagged the S&P 500 over that time frame. That is incredible. What does that tell you? Number one, it tells you how a few years of substantial underperformance can destroy your returns. All right, and look what happened since that period from 2012 to 2018. In fact, let me go back here. From 2015, you right? From 2015 to 2017, what he calls challenging periods. Look at that. Let's have a look. Look, 2015, negative 20%. Negative 20% versus 1.4% for the S&P 500. Then in 2016, negative 13.5% versus 12% for the S&P 500. In 2017, negative 4% versus 21.8% for the S&P 500. And then in 2018, negative 0.7% versus 4.4% for the S&P 500. This, guys, is really bad. And you can see how much this can hurt your performance despite the subsequent years of stellar outperformance. And that was definitely the case. Look what happened after 2019, 58% versus 31% for the S&P. In 2020, 17.2% versus 18% for the S&P. In 2021, 26 versus 28% for the S&P. In 2022, only down 8.8% versus down 18% for the S&P. So you can see that his returns have been a lot less volatile as well over time. So while the markets crash a lot, it doesn't crash that much, right? And then when the market is doing very well, his returns also deliver exceptional outperformance. All of that since 2018, right? Which is really amazing, amazing. But then the other problem, guys, is the fees. Look at the fees of his fund. Look at that. From 2004 through 2012, as you can see, Pershing Square charged 1.5% management fee and a 20% incentive fee. And now they changed that. So from 2012 all the way to today, they are charging 1.5% management fee and a 16% incentive fee. And what happens is during down periods, right, during down markets, those fees are really going to hurt. They're really going to hurt. And that's why we believe that you don't need to pay an investment fund to manage your money, because if you follow the principles that we so openly describe at Like a Tortoise, you will make money without having to pay these crazy, crazy fees, right? And I think chances are that you will do your average of 15% per year over the very long term. if you follow these principles. As simple as that. So I would trust your capital to an investment fund when most of these funds actually tend to outperform over time. And with all due respect for Mr. Bill Ackman, we can see that since 2004, all the way to 2026, he has indeed delivered a stellar return, right? Almost 16% versus 10.7% for the S&P. But since 2012 through today, he has significantly lagged the S&P 500. So I mean, anyway, it's what it is. Now, what else do I want to discuss? I want to talk about his portfolio positions right now, changes that he made in the portfolio, right? So let's jump right into that part. And you can see that the 2025 top contributors were primarily Alphabet. And I have great respect for this investment because he started building a position in Alphabet when the stock was trading at the forward PE of about 15th. And sure enough, what happened ever since is nothing short of outstanding, right? Alphabet is more than double this position by now, I believe. So great performance. Look, so you can see that he runs a concentrated portfolio of high conviction companies, and we will talk more about that as well. But yeah, so these are the main contributors: Brookfield, Uber Technologies, but the main contributor is definitely Alphabet. Then you have the main detractors, namely Chipotle Mexican Grill, which crashed substantially, as you guys know, some 60% from its all-time highs, and Nike, which is sold in the dump. So total detractors underlying portfolio negative 7.1%. And then let's have a look at this in more detail. I want to see business and organizational update. Portfolio developments. Okay, so positions acquired in the last 12 months. He bought Hertz. He bought a position. He started a position in Amazon and Meta, right, in 2026, 2025. At these levels, I mean, these will never. I mean, he obviously paid what he called a fair price, but bear in mind that Bill Ackman would use, in my opinion, I think he used about 10% discount rate. That's what most of these asset fund managers use, and many investors as well are outside the um, the hedge fund space. They typically use 10% as the discount rate. I like to use 15%, as I already told you. And what that does is it really well it compresses the intrinsic value of the business because you are discounting the future cash flows at a higher interest rate, right? If you are using 15%, and so the intrinsic value per share as a result comes down, right? In addition to that, so not only is he using 10%, which of course gives the intrinsic value, makes the intrinsic value more higher than mine, but he's probably doing growing Amazon is projecting probably 17 or 18% growth for Amazon, and I don't go above 15% so I don't project growth above 15%. That is my maximum over 10-year period because there is so much that can happen. I want to have that built, that margin of safety, that additional margin of safety built into the model as well. Okay, so and he exited positions in Nike, and he talks about why that happened. And look, he made two investment decisions that I didn't really like. He made an investment decision, and I didn't like. I think he just panicked, in my opinion. But anyway, let me talk to you about that. So one of them was Netflix, right? Let me show you right here. If you are watching this for the first time, I'm sharing my eToro account, but I don't use eToro to execute my the company's transactions, right? So I use eToro for educational reasons, and I use Interactive Brokers to execute all of our company transactions. And that said, let me go here. And look, this is where he was buying, right? So he was buying Netflix around $36, $39 a share. And then when the stock crashed further on the back of weak earnings reports, on the back of the week's earnings report, he exited. And he mentioned that the ability to predict the earnings growth of the company is a bit cloudy, and so they exited the company. And sure enough, they sold when they should have bought more. And the company went on to deliver outstanding results for patient shareholders, right? And this is what happened to Nike. And in my opinion, this was even worse, if you ask me. Um, Look, it remains to be seen whether this was another a Netflix type of mistake that he made or not. But he was buying right here, right around the around $97 a share, and then he even doubled down, right? He doubled down, so at about 80, or no, excuse me, a bit lower at about $78 a share, and then when the another crash came, he exited, right? He exited. So, and this is where we are right now. I can see consolidation. And now it remains to be seen whether this was another huge mistake because Nike has a big competitive advantage. In fact, if you go to Morningstar, they mentioned that the moat of Nike is wide. The reason I didn't buy Nike and I preferred Lululemon is because of the asymmetric potential with Lululemon. I like my risk reward a lot more with Lululemon. Number one, because Nike's revenues had been compressing, so the business has been declining, and despite all the headwinds, Lululemon never compressed. Revenues have always grown, and that is something that I like. In addition, as you guys know, Lululemon's growth runway is a lot more attractive than that of Nike because Nike is already everywhere. And so I think the potential growth for Lululemon as a much smaller company is a lot more interesting than Nike. Okay, not to mention that Lululemon's financials are so ahead of Nike's. I mean, it's just ridiculous. We can talk about margins, we can talk about everything. I mean, the fundamental picture of Lululemon is so much better than that of Nike. But anyway, let's continue. Okay, so these two investment decisions are I didn't like to see. I didn't like to see, and but anyway, let's continue with that report, and then so he started a position in Amazon in Meta, right? And then he talks more about that right here. Let me see. Yeah, he talks about how mega caps are powering higher earnings growth. We've mentioned this many times, and because he already has Google in his portfolio, and now he bought Amazon and Meta. Look at that, right? So he effectively has three of these Wall Street darlings in his portfolio. But what's incredible as well is that look at that. We have increased our exposure to high quality, higher growth mega caps, right? And we can see we believe these companies offer structurally higher growth than most companies in the S&P 500 at only modestly higher average multiples. Look what he says. So, for example, for Uber, the PE multiple stands at 21 times, right? And you contrast that with Nike, excuse me, with the market's OPE, which currently sits much higher than that, right? But then look what happens. So the PE multiple of Uber sits at about 21. In fact, I think this is even lower now because Uber has been facing some selling pressure. So let me have a look right here. And I think that has compressed. Uh, so Uber, let me have a look. What's the forward PE of Uber? Uh, at about the same look. So it's about 20.97, right? And you can see that analysts rated with a strong, rated as a strong buy at these levels. But yeah, let's continue. And okay, let's continue right here. Look at the medium term EPS growth, around 30%. So what he's saying is, okay, so while we are paying a PE, a forward PE of about 20 times, the growth is the projected growth going forward is about 30%, which means the PEG, right? So the price to earnings growth multiple is actually under one, which makes the company cheap, right? So with Amazon, the P is about 26 times. I don't think the P is adequate for a company like Amazon. Well, actually, yes, you can definitely use the free cash flow is not the metric for Amazon because of all the investments that they make, but the net income, this is something that you can use. Yes, and so it sits at 26 times versus about 20%. So he says it's reasonable. And same story for Alphabet. I mean, look, would I ever pay 27 times for a company? No, I wouldn't. But neither did he. Remember, he bought Alphabet at about when the multiple was at about 15, and that is a much more interesting valuation level, certainly from a PE standpoint. And so, hats off to him. Meta, 22 times. I mean, it's not egregious, again, for a high quality company. It's still not the multiple that I'm willing to pay, right? And so, what he says is that he believes that these mega caps that we own are trading at compelling valuations relative to the overall market in light of their superior business quality and growth profiles. Uh, and so changing narratives create opportunity. Bingo, right? This is what he's talking about. Google, look at that. He bought in 2023 the bear narrative around Google being an AI loser with search vulnerable to disruption by competitors such as ChatGPT. Fast forward a couple of years, boom. Consensus forms that Google is an AI winner with Gemini 3 viewed as a leading large language model. So hats off to him. This investment has been fantastic for his portfolio. Okay. And what he's saying right here is that, look, with regards to Uber, we are delighted to own Uber's 30% earnings per share growth at only 21 times, while we believe the company disproves concerns around autonomous vehicles. Very interesting. Market macro volatility dislocates valuation, right? So he believes that is the case for a company like Amazon. He also believes that is the case for a company like Meta. And so now I want to wrap up with his reasoning for around selling Nike. Uh, and let's continue. So we already addressed Uber, okay, which is very good. And you guys, if you want to have access to this report, you can go to Pershing Square's website, and you can see in the investor presentation, you can download the report. Okay, it was published on February the 11th. And there's a lot that we can learn from these great investors. And there are things that I don't agree with, but certainly this gives us a sneak peek, right? Insights into their framework. So, which is very good. But let's have a look at the detractors. You can read more about this stuff. Where is that? We have to scroll down. Our Hughes, share price. Okay, so exited positions right here. So it's on page 74. Chipotle. Chipotle's turnaround created exceptional value for all stakeholders. Here, look what he says right here. Okay. Yeah, look, filed 13D with 9.9% ownership in September 2016. Board refreshed accomplished 3 months later, including 2 directors from Pershing Square. You see, because he bought a stake in the company as an activist investor, and he wanted to turn it around. Board recruited Brian Niccol to succeed founder as CEO in February 2018. From 2017 to 2024, same-store sales growth averaged 8.5%. EBIT, which is operating income margins, expanded by 13 percentage points, and earnings per share grew at a 35% CAGR. We sold 83% of our initial shares during this period at attractive returns. Recent struggles under new management have clouded the earnings outlook. It's interesting. He's mentioning the same factor that caused him to sell Netflix. Clouded earnings growth outlook. New CEO named in August 2024 following Nicole's departure to lead Starbucks. Okay. SSS began to slow in early 2025 and have since turned negative. We didn't adequately adjust our assumptions and required returns following these changes, especially in light of 2025 starting valuation of 45 times NTM EPS. Okay, cool. So we believe Chipotle remains a great business with a long growth runway. The wide range of potential future outcomes led us to sell our remaining shares. Okay, so let's talk about other exited positions. I wanna focus on Nike because he even doubled down. When you double down in a position, then I mean I understand selling your one time investment in a company, but when you double down, then you should have already done a lot of homework, right? Because you made the decision that you are buying more shares. So why did he exit this position? I just don't agree with it. I also think once again he may have panicked at the lows. We underestimated the problems created by prior management, both in our initial due diligence and in the impact of actions required to effectuate a turnaround. EPS estimates declined by 25% from when we acquired our position in spring 2024 until new CEO Elliot Hill's start date in October 24, while margins are currently depressed. We grew uncomfortable with underwriting a return to pre-COVID levels in the medium term. Competitive landscape in athletic footwear and apparel is now more fragmented. Gross margins likely structurally lower across the industry due to tariffs. So, look, guys, it remains to be seen whether this is going to be another Netflix type of mistake. I didn't like these two investment decisions that he made. So certainly, I mean, other investments have bode very well for the business, which is good, and for his investors. And I have the utmost respect for Bill Ackman, but Nike and Netflix. I think Nike is gonna be another big mistake, and I think as the consumer in the US becomes starts to perk up, because remember, these companies in the consumer discretionary field have taken a massive hit because customers, right, are very bearish. They are curtailing spending. I showed you a graph not just a few videos ago, showing that consumer mood is really at near almost at all-time lows, which is incredible. And so once this start turning around, as people become more incentivized to spend more, companies in that space like Lululemon, Nike, and even Chipotle Mexican Grill are going to do very well. And so anyway, it remains to be seen who is right, who is wrong. But yeah, it was his decision at the end of the day, and we respect that for sure. And we like the fact that he's very open about his investment mistakes, and so are we. And if we make mistakes, we are the first. We are the first to come out. We are the first to step forward and to acknowledge that. Okay. So guys, smash the like button if you like this video. I do hope it was insightful. And thank you so much again for all the support that you guys have been showing here on the channel. And stay tuned for more. Have a great weekend ahead, everybody. Be a tortoise.